Hello all, in this video we are going to discuss the measurement of non-current asset held for sale. So non-current asset held for sale should be valued at lower of carrying amount and fair value less cost to sell. So this non-current asset held for sale is valued at lower of these two amounts because it ensures that the financial statement numbers are not overstated and it is according to the prudence or conservatism principle of accounting. Presentation and disclosure. Held for sale assets will be classified as a separate category of current assets, separately disclosed below the normal current asset section. So once an asset has been classified as a non-current asset held for sale, it should be shown under the current asset section of the balance sheet. And once an asset has been classified as a non-current asset held for sale, it should not be depreciated further from the date of classification. So for example, let's say that on 31st March, you are classifying an asset as a non-current asset held for sale. So from 31st March, you should not depreciate the asset anymore. Any asset valued under revaluation model that meet the criteria of an asset held for sale should first be revalued as normal and then separately returned down to the fair value less cost to sell. So for example, let's say that you have a property, plant and equipment and you are valuing that property, plant and equipment under revaluation model according to IAS 16. So in such a case, if that property, plant and equipment meets the criteria for held for sale, you should revalue the property, plant and equipment to its market value first. Only then you need to write it down to its fair value less cost to sell. So it requires an illustration to understand. So for example, property, plant and equipment measured using revaluation model with a carrying amount of $10,000. So the carrying value of the PPE is $10,000, and that PPE met the criteria of an asset held for sale, and the fair value of the asset was $12,000 and the cost to sell were $3,000. So the first step here is to revalue the asset first. Here the journal entry will be debit property, plant and equipment and credit revaluation reserve 2,000 debit and 2,000 credit. The carrying value of the asset is now, after revaluation, the carrying value of the asset is $12,000, whereas the fair value less cost to sell is 9,000. So this 9,000 is nothing but the difference between fair value of the asset and the cost to sell. So 12,000 minus 3,000 will give you 9,000. Thus, the value of the non-current asset held for sale should be written down to 9,000 because see, the carrying value is 12,000, whereas fair value less cost to sell is 9,000. And here we have seen that non-current asset held for sale should be valued at lower of carrying amount and fair value less cost to sell. In that question, the carrying amount is 12,000 and fair value less cost to sell is 9,000. So obviously the non-current asset held for sale should be valued at 9,000. So the remaining 3,000 will be your impairment loss. And we have already discussed in IAS 36 that if carrying value of the asset is greater than the fair value less cost to sell, in that case, you need to book an impairment loss. So here in this question, an impairment charge of 3,000 should be charged to the P&L. So the journal entry will be debit asset held for sale because in your current asset section, your a new asset is coming, so that should be debited. Increase in assets should be debited, and P&L account should be credited because it's a loss. The nominal account, the golden rule for nominal account says that debit all expenses and losses, credit all incomes and gains. Since it is a loss, the P&L account should be debited of $3,000 and credit property, plant and equipment. This property, plant and equipment is removed from the non-current asset section of your balance sheet. So any reduction in assets should be credited. So $12,000 should be credited here. So now let us look at an illustration. On 1st January 2018, an entity Mike purchases a machine for $20,000. It has an expected useful life of 10 years and nil residual value. So the residual value of the asset is 0. The entity uses SLM method, that is straight line method of depreciation. On 31st December 2019, the entity decides to sell the machine. So after using the machine for 2 years, the entity has planned to sell the machine. Its current market value is $15,000 and the entity is confident that they will find a buyer very quickly due to short supply in the market for this type of machinery. So the condition for condition for non-current for classifying the asset as a non-current asset held for sale is satisfied here. It will cost the entity $500 to dismantle the machine. So this $500 is nothing but cost of disposal. At what value the machine should be included? Should the machine be included in my case statement of financial position at 31st December 2019? So basically in this question they are asking us at what value the non-current asset held for sale should be shown in the statement of financial position. So for that, first we need to calculate the carrying value of the asset on 31st December 2019, and we need to calculate the fair value less cost to sell, and we need to compare the carrying value of the asset to the fair value less cost to sell, whichever is lower, and that is your answer. So here the solution is, first, we need to calculate the carrying value of the asset as on 31st December 2019. See, we have purchased the asset for $20,000 and we have used it for 2 years. So we need to reduce the accumulated depreciation for 2 years. Depreciation for 1 year is 20,000 divided by 10, because the cost of the depreciation is 20,000. There is no residual value. So 20,000 minus 0 divided by 10, we get 2,000 as a depreciation expense for 1 year, but we have used the asset for 2 years, so the accumulated depreciation will be 4,000. That is 2,000 into 2. So the current carrying value of the asset becomes 16,000, which is nothing but 20,000 minus 4,000. And in the question they have given the fair value of the asset is 15,000, and cost of disposal is also given in the question, that is 500, and fair value less cost of disposal is 14,500, which is nothing but 15,000 minus 500, and you get 14,500. So now compare this fair value less cost of disposal to the carrying value of the asset, which is lower. Fair value less cost of disposal is obviously lower, 14,500. So in your statement of financial position, you should show non-current asset held for sale at $14,400. And since the carrying value of the asset is greater than the fair value less cost of disposal, an impairment charge of 1,500 will be recorded in the statement of profit and loss, and the machine will no longer be depreciated because it is classified as a non-current asset held for sale. And we have two more examples, that is BN has an asset that was classified as held for sale as on 31st March 2012. The asset had a carrying amount of $900 and the fair value of the asset is $800. Cost of disposal is $50. Everything is given in the question. The carrying value of the asset is given, fair value is also given, cost of disposal is also given. And in the question they are asking us to calculate, according to IFRS 5, non-current asset held for sale and discontinued operation, which of the following values should be used for the asset in BN's statement of financial position as at 31st March 2012? This is similar to what we did above. So first we need to calculate the carrying value. Here they have already given the carrying value. Fair value of the asset is also given. Cost of disposal is also given. Fair value less cost of disposal is 750, which is nothing but the difference between 850. It gives you 750. Now compare the carrying value of the asset and fair value less cost of disposal, which is lower. Fair value less cost of disposal is lower. So in the statement of financial position, the non-current asset held for sale should be recorded at $750. The last example, WZ is an assistant accountant with ABC. On 31st March 2011, ABC decided to sell a property. This property was correctly classified as held for sale in accordance with IFRS 5 non-current asset held for sale and discontinued operation. In its draft financial statements, ABC has written down the property by $3.4 million. The write down was charged to the statement of profit or loss for the year ended 31st August 2011. So the year end is 31st August 2011. The draft financial statement showed a loss of 1.3 million for the year 31st August 2011. Which of the following statements correctly show how WZ should treat the asset? So let us look at options one by one. The asset should be shown under PPE until the asset is sold. This is not correct, because once an asset has been classified as a non-current asset held for sale, it should be removed from the non-current asset section and it should be shown as a separate line item. So option A is not the right answer. The asset should continue to be depreciated until it is sold. No, this is also not right, because once an asset has been classified as a non-current asset held for sale, it should not be depreciated anymore. The asset should be shown separately under assets held for sale. So option C is correct, because once an asset has been classified as a non-current asset held for sale, it should be shown as a shown as a separate line item under current assets section of the balance sheet. And here they're asking for which two of the following statements. So we should proceed further. Depreciation should cease at 31st March 2011. So this is also correct, because on 31st March 2011, ABC has decided to sell a property. So once an asset has been classified as held for sale, it should not be depreciated anymore. So depreciation should cease at 31st March 2011 itself. The final option is depreciation should cease at 31st August 2011. See, 31st August is the year end. You should not depreciate the asset once it has been classified as held for sale itself. You should not wait for the year end and all. So option C and D are the right answer.